Ladies and gentlemen, good day and welcome to IndusInd Bank Limited Q3FY22 Earnings Conference Call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Suman Katpalia, Managing Director and CEO, IndusInd Bank. Thank you, and over to you, sir.
Good evening, and thank you for joining this call on a Saturday evening. I will start with some macro commentary and then go into the bank-specific details. We will upload this commentary on our website for ease of reference. Economic activities continues to gain strength, helped by a release of pent-up consumer demand during the festival season, pick-up in general government spending, strong public investments, and record exports. This recovery was reflected in the highest quarterly GST collections and improved bank credit growth. The recovery may see some impact due to COVID-19 pandemic resurgence. However, increasing coverage of fully vaccinated population and low hospitalization rates so far have ensured limited restrictions. On the global front, major global central banks have put forth guidance of faster than anticipated monetary tightening over 2022. While this can disrupt the easy financial condition, exert upward pressure on rates, we expect that the domestic monetary policy to remain supportive to strengthen the nascent recovery of pursuing a gradual normalization. The budget for the next fiscal would be to look to enforce a structural push for the economy by channelizing a greater share of public resources towards investments and further incentivizing a private capital cycle. Coming to quarter 3, this quarter our focus was on addressing the concerns on microfinance. We ensured Bharat financial operations remain smooth and without any impact on customer servicing or collections. We have completed the internal review. In addition, the bank appointed external consulting firm to undertake an independent review which is underway. The updates of both the reviews, including financial implications, are broadly in line with management expectations. I will share further details subsequently. Maintaining disbursement tractions on non-MFI portfolio. The overall loan group grew 4% quarter-on-quarter. Our vehicle finance disbursements are up 5% quarter-on-quarter. The strong disbursements ensured the vehicle book grew by 2% quarter-on-quarter, reversing decline in the previous 2 quarters. The consumer loan book other than the vehicle and MFI too grew by 2% quarter-on-quarter. The corporate loan book has maintained its growth trajectory after the last year's consolidation with a quarter-on-quarter growth of 6% driven by SME and small corporates. We were cautious on microfinance disbursements pending reviews during the last quarter, and they have already picked up for this quarter. Continued deposit momentum. Our deposit growth was strongly at 19% year-on-year and 3% quarter-on-quarter. We let go of some expensive deposits given abundant liquidity. This helped us further reduce the cost of deposits to 4.66 from 4.85% last quarter. Asset quality. Slippages during the quarter, net of upgrade and recovery, were at 0.9. As expected, bulk of the slippages were from the microfinance at 4.4% of MFI book, whereas slippages from the balance 88% of the loan book was contained at 0.3%. Our GNPAs have reduced to 2.48% from 2.77%, and the restructured book too reduced to 3.3% from 3.6% quarter-on-quarter. We have maintained our PCR at 72% and increased our contingent provisioning to 3,328 crores or 1.5% of loans. Maintaining profitability of the franchise. Our net interest margin improved to 4.1%, helped by falling deposit costs. The non-interest income continued to remain healthy, growing at 14% year-on-year. Our cost to income increased marginally to 41.6%. This resulted in maintaining a healthy PPOP margins at 5.90% of loans. Digital launches. We launched Indus Easy Wheels during the quarter, a portal for used vehicle ecosystem. We scaled up our Q2 launches of Indus Merchant Solutions at Indus Easy Credit Stack for business and debit card EMI on IndusInd Bank debit cards in Q2. We went live with updated version of Indus mobile app and enhanced security features and improvements. The mobile app has seen good response with the user base increased by 36% year-on-year. Overall, we remained on track on digital along with new initiatives on individual and vehicle finance segment planned for launch in the coming quarter. Now coming to individual business, microfinance. I will start with an update on the reviews followed by business performance during the quarter. As informed earlier, the board of the bank conducted internal review on the anonymous allegations received in Q3 financial year 22. We have completed the internal review. In addition, the bank appointed external consulting firm to undertake an independent review which is underway. Based on the findings of the internal review and the preliminary status update provided by the external consulting firm, key findings and action initiated by the bank are as follows. A microfinance product was offered to provide liquidity support for customers impacted by the COVID second wave after they cleared existing dues. However, it was observed cash disbursements and repayments of arrears took place on the same day, which is a procedural lapse. The product was discontinued in September 21 and prior to the receipt of the anonymous complaint. The standard loans outstanding under this product were rupees 179 crores as of December 2021. The bank has on a prudent basis fully provided for this exposure during the quarter. All microfinance products required disbursement of loans with a biometric or an OTP consent from the customer. It is confirmed that the disbursement of loans without client consent getting recorded was as a result of a system issue. The standard loans outstanding for such customers were rupees 7 crores as of December 21. Prior to receipt of the anonymous complaint, the bank had changed the disbursement process wherein loans are disbursed only for biometric consent except for one state, which is Assam. Few areas of scope for improvement in governance and oversight of the banking correspondent activities of the subsidiary are highlighted. Steps have already been undertaken, including strengthening of process controls, integration of control functions, and formation of an oversight committee, etc. The management has evaluated the matter of possible impact on the asset classification, revenue recognition, and provisioning. Further evaluation also included factors which could lead to regulatory issues, and they have been also addressed adequately. The bank will also constitute a committee to assess staff accountability, if any, arising of the findings of the review. Now coming to the business of microfinance during the quarter. The increasingly broad-based recovery in economy was also reflected in the microfinance business during Q3. The COVID third wave too did not affect rural India as much as urban locations. Bharat Financial added 564,000 customers during the quarter. The member acquisition has picked up this month, and as business activities are improving across India. The positive momentum in business activities was also reflected in improvement in collections. Collections efficiency in December 21 was at 93% on overall book and 98% on standard book, excluding NPAs and restructured book. West Bengal and Kerala continue to pull the overall collections down with collection efficiency of 95% and 91% respectively on standard book. With Q2 incremental NPA customers, within Q3 incremental NPA customers, 70% of the customers paid some installment during Q3, indicating potential for recoveries even though we have made conservative provisioning. And overall NPA base, 40% customers paid some amount during Q3. The restructured book was at 1,003 crores against 907 crores quarter on quarter. Overall for Bharat Financial, 86% of customers paid all weeks in December, 8% are intermittent pays in December, and 6% are non-paying. Among standard portfolio, only 2% of clients are not non-paying. This also reflects in terms of quality of portfolio outstanding, wherein portfolio current on all installment has improved quarter on quarter from 83% to 92% of standard portfolio. Our 0 to 90 DPD book has reduced quarter on quarter from 4,446 crores to 2,153 crores, of which 60 DPD book is 643 crores. The net slippage during the quarter was rupees 1,239 crores. The net slippages cumulatively for the 9 months financial year 22 was rupees 1,851 crores or 6.7% of the book. Looking at the performance of the overdue book as of now and assuming coverage of 80 or 90% of the delinquent book, we remain confident of the credit cost from MFI book for the year to be broadly around 6 to 8% as stated earlier. We continue to scale up our non-microfinance activities. The merchant acquisition business grew to 437,000 merchants from 320,000 merchants quarter on quarter. The loan book from these customers was at 1,463 crores from borrowing customer base of 261,000 merchants with 98.2% collection efficiency. We have also further scaled Bharat Money stores from 91,000 to 94,000 during the quarter. Overall, we remain committed to the microfinance business. The Bharat Financial business model has delivered outperformance versus the industry, not just in COVID, but also in disruptions pre-merger. Bharat Financial prides in being a process-driven organization. The focus for this quarter will continue to be on improving field discipline, process tightening, and quality control without impacting customer acquisitions and collections. Vehicle finance. Our vehicle finance disbursements for the quarter were at 8,800 crores, reflecting 5% quarter on quarter and 14% year-on-year growth. Similar to the quarter two, the disbursements are also higher than the pre-COVID levels. Within vehicle categories, disbursements are now ahead of the pre-COVID levels for commercial vehicles, cars, utility vehicles, and tractors. The three-wheeler and two-wheeler volumes will take a few quarters more for the COVID impact to pass. Strong disbursements in the last 2 quarters have resulted in the vehicle book growing by 2% sequentially after being stagnant or declining for the past few quarters. We have maintained or gained market share in most of the vehicle categories except two-wheelers. The vehicle finance restructured book remains stable at 3,769 crores quarter on quarter with marginal fresh additions during the quarter. The collection from the restructured book too improved to 87%. Collection efficiency from the rest of the book is back to normalcy. We see continued improvement in freight availability for existing vehicles along with stability in fuel prices. This has supported the portfolio quality and will also result in new vehicle demand for the coming year. This is also evident in the quarter 4 so far with disbursements improving further. We aim to maintain the growth trajectory, distribution reach, and work towards improving to pre-pandemic levels in the last quarter as well. On the vehicle finance management leadership front, Mr. Parthasarathy has identified A.G. Sriram as his successor. A.G. Sriram has been with the bank for over 3 decades, running large portfolios including commercial vehicles and construction equipment. A.G. Sriram is being groomed over the last several quarters to take on the leadership role. Mr. Parthasarathy has been instrumental in building the vehicle finance domain for the bank and continue to be associated with the bank post-transition as a mentor to A.G. Sriram. Other retail assets. This segment contributes 15% of the overall book and includes non-vehicle, non-MFI products. The loan book grew up 2% quarter on quarter, driven by growth in both secured and unsecured products. Credit card spends continue to reach new heights every quarter, with quarter 3 spends at rupees 14,256 crores, growing 28% quarter on quarter. The secured asset disbursements were among the best in last several years. The segment, however, is witnessing intense competition and we have to let go of customers where risk reward was not favorable. The collections from this customer segment are back to pre-COVID levels with the net slippages well under 1%. Corporate bank. The corporate bank book maintains its growth trajectory with quarter-on-quarter growth of 6%. YOY growth was strong at 19%, albeit on a weaker base. We continue to focus on well-rated corporates with average rating profile of the corporate book improved to 2.67 from 2.76 YOY, that is equivalent to A rating. The growth was driven by demand from NBFCs, small corporates and SME. The slippages from the corporate book remained well contained in quarter 3, slippages at 56 crores. This would be one of the lowest quarterly slippages in the last several years. A part of the corporate book under restructuring will complete 1 year of satisfactory performance and expected to be upgraded this quarter. We are however watchful about developments in one of the restructured accounts under litigation. Our exposure to stressed telco was at 30 billion as of December 21, of which funded is 10 billion and balance non-funded. The consortium is evaluating a business plan and we will update you at an appropriate time. During the quarter, we sold down one of the IIFL exposure to an ARC for rupees 240 crores cash recovery with an upside participation on final recovery. The exposures have already been written off and recovery is used to augment the contingent provisions. The gems and jewelry book reduced quarter on quarter due to repayments and is maintaining its asset quality with zero NPAs. Overall, the corporate franchise has seen a comfortable turnaround with focus on growth compliant with the underwriting framework. Now coming to deposits. Deposits grew 19% year-on-year, driven by 24% year-on-year growth in current and savings accounts, and retail deposits as per LCR grew by 32% year-on-year. The growth is achieved along with reduction in cost of deposits. Our cost of deposits reduced to 4.66% from 4.85%, showing a decline of 19 basis points during the quarter and 139 basis points cumulatively in 7 quarters. We continue to remain surplus on liquidity and let go some of the expensive deposits during the quarter. The certificates of deposit reduced in absolute as well as proportion of deposits during the quarter. The CDs now form 2.2% of the overall deposits. Affluent segment total AUM stood at 60,000 crores, showing a YOY growth of 25%. In the same period, total deposits in the segment grew by 21% and stood at 35,000 crores. The growth in deposits is driven by CASA, which grew 37% year-on-year and 4% quarter-on-quarter. Deposits from the NR segment has been holding up well at 27,000 crores. The NR market has seen a sharp fall in the fresh inflows of the deposits this year. We have, however, gained market share this year till date and aim to maintain the trajectory. We have maintained our overall LCR at 137% and were running surplus cash balances and excess investment of over 60,000 crores. Digital traction. We have been executing a digital strategy focused on A. Improving efficiency of existing business, B. Creating new digital business models, C. Building digital propositions with a wider ecosystem. Over the last 9 months, we have built a comprehensive stack of digital platforms to serve the needs of retail, individual and SME clients. These include Indus Smart for investments, Indus Forex for reach, and recently launched Indus Easy Credit for personal loans and credit cards, as well as purchase financing on debit card spend. In the MSME space, during the year, we launched Easy Credit for business and Indus Merchant Solution to meet banking, payment and lending needs for small entrepreneurs. Consequently, our digital sourcing mix continued to increase during the quarter. Overall, 92% of the transactions happened digitally and 71% of overall service requests are now processed via digital channels, up from 68% a year ago. New developments during the quarter include: we opened up Indus Easy Credit Stack for credit cards to various channel partners and employees, as it is gaining transactions in more than 120 offline channel partners. We also integrated 2 digital partners and several more in the pipeline. The platform is generating over 300,000 inquiries every month. With the platform launch, our cost of processing per application has come down by 80% as printing, dispatch, scanning, data entries are eliminated. We launched an enhanced version of Indus mobile app with better user experience and security features. The mobile app continues to be rated 4.3 on Play Store, and IBL mobile and UPI transaction growth almost doubled YOY. We enhanced features on WhatsApp banking, including PDF statements, card balances, and bill payments. We saw good engagement on WhatsApp with 3.6 million user register base and over 1 million conversations every month. WhatsApp banking user base has increased by 82% year-on-year, and transactions are up 2.9 times year-on-year. Indus Merchant Solutions, a one-stop solution app for small merchants, saw a good response in the initial months of launch and garnered an install base of 10,000 plus organically, with 60% of the new to bank users indicating wider acceptance of solution offered by the app. As we start the media campaign from this quarter, we expect a momentum to build in the coming quarters. The bank has launched Indus Easy Wheels. The website hosts ancillary services like roadside assistance, mechanic services, insurance, which is the first of its kind in the market. The portal also hosts the repossessed vehicles of the bank for auction and provides a smooth user experience for anyone looking for pre-owned vehicles. This is the first step in the journey of vehicle discovery, and the future roadmap will include bringing in more inventory from aggregators, dealers, provide customer value-added services on such customer touchpoints. The vision is to create a wholesome customer journey to complete vehicle ownership cycle and give enhanced user experience, transparency, and value. The channel is expected to bring in niche digital footprint and market recall of vehicle finance. We also continue to build our open banking platform banking strategy, leveraging the bank's API live with 250 partners so that we can extend banking services and by embedding ourselves onto partner platforms. Now coming to the financial performance for the quarter. Net interest income grew for quarter 3 at 3,794 crores, grew 11% year-on-year, and operating profits at 3,312 crores was up by 12% year-on-year. Our operating profits margin remained healthy at 5.90% of loans. Net interest margin improved during the quarter from 4.07% to 4.10%. The improvement was driven by continued reduction in the cost of deposits from 4.85% to 4.66%. The yield on advances came off from 11.66% to 11.36% due to higher share of corporate loans and with better rating profile and slower MFI disbursement. Other income grew 14% year-on-year. Retail fees contribute 58% to the total fee income. On the cost side, we resumed investments in our branch network, adding 88 branches during the quarter, taking our branch count to 2,103. We continue to invest on the digital initiatives as well. Our cost to income ratio was at 41.6% for the quarter. On the asset quality and the provisioning front, our provisions for the quarter were at rupees 1,652 crores. Net slippages for the quarter were at 0.9% of loans. As expected, bulk of this came from microfinance at 4.4% of loans, whereas net slippages from the rest of 88% of the book were contained at 0.3% of loans. Our coverage on microfinance NPA is at 95%. We also have standard provisions of rupees 368 crore towards full coverage on products with procedural lapse and 10% provisions on all 30 to 90 DPD loans. We also additionally carry significant contingent provision for restructured loans. We are thus well provided on the existing as well as potential NPAs in microfinance. Overall, the GNPA for the bank has moved down to 2.48% from 2.77% quarter on quarter, and net NPAs were down to 0.7% from 0.8% quarter on quarter with PCR of 72%. The restructured book reduced from 3.6% to 3.3% quarter on quarter. We have used recovery from IL&FS exposure to improve our contingent provision to 3,328 crores, amounting to 1.5% of loans. Total loan-related provisions are at 3.7% of loans or 144% of gross NPAs. Our SMA-1 and SMA-2 book was at 25 basis points and 59 basis points respectively. Net security receipts were at 85 basis points versus 71 basis points quarter on quarter. Profits for the quarter were at 1,242 crores, growing at an 8% quarter on quarter and 50% year on year. Our CRAR, including profits, improved to 19.07% from 18.06%, with CET1 ratio at 16.14%. The CRAR was also boosted by the Tier 2 issuance of 2,800 crores during the quarter. Overall, I think quarter 3 was one of the toughest quarters since the first COVID wave, and outcomes have been what we have been communicating. We are all thus well poised and pivoting to growth as reflected in disbursements as well as collection in the 88% of the non-finance microfinance book have been stable. The book grew 4.3% quarter on quarter and with 30 basis points of net slippage. We expect these portfolios to maintain this trajectory. The microfinance portfolio has seen slippages broadly in line with our expectations. The update from internal as well as external reviews also corroborates our views. The disbursements are now back on track and we expect loan book to grow here on. We have conservatively chosen to take the microfinance credit cost through the P&L along with augmenting contingent provisioning. The contingent provisioning position us well to mitigate future credit cost cycles. The liability franchise continued to scale up with reduction in cost of deposits. We are well positioned for the upward rate cycle as well. We are well on our track on executing our digital strategy. We have so far launched 3 out of the planned 5 initiatives: IndusInd Credit, Merchant Acquiring, and Vehicle Finance Portal. These are being scaled up. The other 2 millennial and SME offerings are planned for the launch in the couple of quarters. The profitability of the franchise remains healthy at 5.90 PPOP margin. ROA and ROE continued the journey towards normalization and should see further improvement as microfinance costs have peaked. While the COVID remains a risk to watch out for, the implication of the recent wave on our business have been limited. We are thus committed to executing our strategy quarter on quarter. With this, we can open for question and answer.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and 1 to ask a question. The first question is from the line of Abhishek Murarka from HSBC. Please go ahead.
Yeah, good evening, everyone, and thanks for taking my question. 2-3 questions. The first is this audit report. By when can we expect it? And has any of the slippage or write-off been precipitated as a result of any finding of the report?
So the internal audit report has been presented to the board already, and the committee of the board directors who were reviewing overseeing the audit, we have presented it to the board. I think the external consulting firm preliminary findings have also been reviewed. A status update has been given to the committee of directors, and it has been. So I think the external consulting firm board report should be available very soon. I think they are internally validating the report as well as presenting the report to the management for their comments before they presented it to the committee of directors. So I think it should take a couple of weeks, 2 to 3 weeks before it is out. So that's what I think what we have done, it's not precipitated it. I think we were always, in my first call itself, I had said that we had this provision and we have taken the full provision of this portfolio, which was 179 crores on a particular product.
Okay, and the 368 crores, I think you mentioned that you're carrying separately for MFI. This is outside of any provisions for MFI.
So no. These are for MFI. What I've done is we've taken 10% on 30 plus as an extra provision, and we have taken the current book, which was on current of 179 crores, which was current on this particular product, has been taken as 100% crores. So 179 plus 120 or 130 crores on the 30 plus bucket is what we've taken as provision.
Okay, understood. The second question really is on growth. Now, at the current rate of growth, we may undershoot our guidance of 16-17% growth for this year. What is your view for the following year? You're saying disbursements are kicking back up. So what is your view for 23?
If you look at this quarter too, I think if you would have just seen our growth outside the microfinance was 4.6%. So we are back to 18% to 20% growth year on year. It's not that. If we get our microfinance growth back, which will be 5% quarter on quarter, 6% quarter on quarter, at any cost we will be delivering 5.5% quarter. In my view, our growth is in the early 20s and we'll continue to believe because we have to make up for the lost time which we have done. I think our growth will be in the range of 12 to 13% this year and will go to early 20s in the next year to make up to 16 to 18% CAGR in the planning cycle 5 on the 2-year period.
Okay. And finally on MFI, just a few questions. So you're saying disbursements are back up, but what was the disbursement last quarter and what have you done in January so far? Just to get a sense of the kind of...
The January number, I think it's incorrect for me to. The December results were 7,300 crores approximately. We do an average of 8,500 to 9,500 crores of disbursement.
And we should be back up to those levels in this quarter, let's say.
Yes.
And
I'm talking only about the I'm talking about the member business. There will be another 300 to 400 crores of disbursement which will happen in the merchant acquiring business.
Okay, sure, yeah. And this average ticket size that you have shared, this is on AUM, right? What would it be on disbursements?
It's exactly the
disbursement will be slightly higher, I think 32,000.
32,000, not much of a difference.
It's a 1-year book, it runs down and
Okay. Just so, you're giving anyway quite a bit of data on MFI, on paying, non-paying, disbursements, etc. Just a request, if you can put it in a slide, it just helps us compare because a lot of others give that data. And would be useful to have, at least the basic data about MFI separately. So just a request there.
Okay.
Thanks. Those are my questions.
Thank you, Abhishek.
Thank you.
Thank you. The next question is from the line of Sameer Bhise from JM Financial Services. Please go ahead.
Yeah, hi. Just one question on how does one tie up the number of sale to ARC, which says 740 crore in the presentation and around 2,480 crores in the BSE release.
So if you look at it,
Sameer, the 7487 is the gross amount which is sold to the ARC during the quarter. Within that 750 crores is the CNTL, the IIFL exposure, which was already written off. And the balance is the loans which are sold during the quarter, which are the retail and other assets. The 750, as you know, is the fully provided and written off exposure. Of the balance 1737, there were already provisions sitting on the books. So the net amount is 1213 as disclosed in the SEBI disclosure. And against that 1213, we received a consideration of 740. So that 740 is in the investor presentation. And then 740 is further the usual, whatever the cash and SR book split that you receive against that. So that's how the 2487 flows into the SR book and investor presentation notes.
Okay. I'll probably just run this down once again offline. And secondly, just wanted to get a sense on the corporate book. How is the growth shaping up and from what kind of sectors?
So our corporate book grew by 6%. I think on the large corporates, we are seeing growth in the NBFC segment, which has done very well for us. And we continue to believe that we have about 4.5% of our book there. And we believe that that's a very good business which we are in. I think we've also added to the real estate sector. 2 deals were done. And we did that smaller amounts, but very good deals which we did. On the mid corporates and in the smaller corporate, we saw growth. And we saw the growth specifically in the smaller corporate at about 10 to 12%.
Okay, you expect these...
The RE loan disbursements were for existing projects, which were, for existing projects. So they were not new entrants into the new customers which are acquired. They are disbursed over a period of time.
Okay. And do you expect kind of high teens number to sustain on the corporate side?
I believe so. I think the budget will throw up very good opportunities in the corporate. I think the capex cycle is reviving, and I believe that we will continue to grow on the corporate side. Like I said, our mix will be 45-55, and I think we are in that range on the corporate and retail side. I think we will also see the retail side shaping up. On the retail side, the vehicle is coming from a very low, cyclical downturn, and I think the vehicle side of the business will do very well. Microfinance, there's always a demand, and you will see us growing that microfinance. And on non-vehicle asset business, you will see the growth momentum picking up. And I think all the three businesses are well positioned for growth now.
Okay. Thank you and all the best.
Thank you. The next question is from the line of Kunal Shah from ICICI Securities. Please go ahead.
Yeah. Firstly, with respect to the OpEx, so overall the OpEx has been quite contained, but we have seen a increase across the board. So do we see maybe investing further and we catch up on the OpEx, or we still see like cost to income being managed at this level quite comfortably?
Oh, no. I think what you will see is we will continue to invest in OpEx. So I think OpEx is a very important component, specifically on technology and people we are investing. Our branches, we are growing the distribution, we are investing in technology, and we will invest in people. So I think OpEx will continue. But please understand, the revenues will also grow. We have the nature of our businesses is such that we will continue to grow the revenue. I've always said our OpEx will be in the range of 41 to 43%, and it is contained within that percentage. So to say that the OpEx will not grow, absolute numbers of OpEx will grow. But I think the revenue will also grow to take care of the OpEx.
Sure. Okay. So maybe the way there has been surprise all across that we are not seeing particularly for IndusInd. Maybe I think credit card could be one component of it. But apart from that, I don't think there are.
We have a very small card base of 1.6 million clients. So people have invested a lot during the festival season because of the large base. I think our investment will be 8 to 10 crores. It doesn't move the needle.
Sure. And sorry, I don't know if you covered it earlier, but the write-offs primarily were pertaining to the MFIs, almost like 1,000.
I think let me give you the number. I think we did a write-off of 1,662 crores. 281 crores were from vehicle finance. Secured retail was 41. Unsecured retail was 217 crores. MFI was 928 crores. Corporate was 194 crores.
So MFI was
928 crores.
928 crores. So almost like 4% of the book is something which would have been written off.
Yes.
Okay. So overall, what was the pain if we have to look at it weighed in terms of the entire restructuring plus slippages over past several quarters and the write-offs which have happened? Finally, on that book, what is the kind of pain which we had seen over last 4 to 5 odd quarters?
On the MFI.
Yeah, on MFI in particular.
1,850 crores is the overall slippages over the year on the book. And if you look at it, I think we've touched the peak, and I think you will only see improvements. And I think by quarter one we will be on BAU. There may be an elevated provisioning in this quarter of about 400 to 500 crores, but I see that going down to about 250 to 300, and that is the normal course of the business which will happen in that business. So it has actually gone down dramatically, and that is reflected in the X Plus book that's what I've given you the data, and if you read my commentary, I've disclosed it's almost 50% down.
Yeah. So next quarter we'll still see 400 finance, then thereafter getting settled at 250 odd crores normalized.
I'm saying that you'll have to see the numbers. I'm just giving you. I think it's on its way down, and I think the normalization should happen from next. I think it may be elevated than the BAU next quarter, but overall from quarter one it will be BAU. And this is because I'm not taking any hits to the P&L, to the contingent provisioning, and I'm taking it to the P&L. I could have reduced the cost by reducing it to the contingent provision, and I could have reduced my P&L cost so I'm not using my contingent provisioning right now. And even the excess which I received from the sale of an asset or a recovery, I made a contingent provisioning. So I'm not using that provisioning at all.
Okay. Thanks, and all the best. Yeah.
Thank you. The next question is from the line of Shagun Verma from Goldman Sachs. Please go ahead.
Yeah, hi, Sumant and team. This is Rahul here. Just a couple of questions. Hi, just wanted to understand the behavior on the ECLGS portfolio. So we understand, and correct me if my numbers are wrong, but 4,500 crores was this amount. How has the behavior been, and do we have any microfinance sitting in there? I mean, the exposure that they have extended to.
So let me tell you what is our GCL portfolio. So I think our total overall portfolio is 5,878 crores as of now. And how is the portfolio performing, Ramu?
We've had very marginal, very small slippages in loan against property and others where claims have been made. It's not been anything material as of late. The repayments have started because the 12-month moratorium had ended for some of the early loans that we had given in 2020, but second half of the year. So we continue to monitor it. Nothing material or any flags which have come up on this portfolio, and we haven't seen much traction on disbursements in recent times. And
on the MFI portfolio which you asked, on the product in which we have booked the GECL, there is an 88 to 89% collection efficiency.
Sorry, this 89% collection efficiency is on the MFI book.
On the GECL portfolio.
Yeah, we have a GECL program for MFI clients, which is I think about it's about 89%.
Yeah, 89%.
Of the collection efficiency.
Yeah.
Okay. And the full repayment of this book will happen in which quarter? The fourth quarter?
It goes on for 3 years and 4 years, right? The term of the proposal is 1 year moratorium.
No, I meant moratorium. Yeah, when does the moratorium for the entire book end?
Some of it will end by early next year.
March.
Next financial year, because we were disbursed up to last December, right? So, because of GCL 3 also came in for...
MFI ends in March, in my opinion. MFI ends in March, and the others may end up by end of
3 months later.
Another 3 months or 6 months later.
The bulk of our disbursements happened last year, so many of them have already ended. That's what it is.
We can give you the data. We don't have that real data with us, so I will send you that data uploaded into the investor presentation.
Thank you so much. Helpful. The other question was on the two-wheeler and LAP portfolio. So for the last 2-3 quarters, that book is running down. So when do we see that rundown sort of to start stopping, or maybe disbursements to start picking up in those portfolios?
Rahul,
conscious decision.
No. Rahul, the issue is there is a decline in the two-wheeler industry. We have to accept it. 30 to 40% decline. And that's why while we are maintaining our market share, or increasing our market share, the issue is the number of scooters sold is decreasing. And that is why the book is running down. However, we've seen the turn in cycle now. And I think for the first time we saw a little bit increase. But yes, you're right, the book is running down. And we should start seeing an increase this quarter. But it will be a marginal increase of 30 to 50 crores because the runoff is also very high. On LAP, we will start seeing progressively a great disbursement happening. We did 260 crores of disbursement last month, but the issue is that the runoff is also high. We have to touch to 350 to 400, and you will see the growth happening from this quarter onwards.
Got it. Thanks. And just last question on this employee expenses. So last 2 quarters, the run rate has gone up to 860 odd crores from 600 odd thereabouts. So is it how the run rate is gonna be now, or there is any one-off sitting in there?
No, it will be similar. We've added new people in Bharat Financial. I think we are adding resources in the cost of our resources in technology and digital have gone up. We made a bonus provision which is a little bit higher of the retention of people. We've also given an increment in January to our people at the lower level So I think all around we've done that, but I don't think it's going to be at that level for some time because it's all the cost which has been added up to that level. But we continue to believe we will be between 41 and 43% efficiency of our business.
Got it. Thanks, Sumant, and wish you and your team a very good luck for the future.
Thank you. The next question is from the line of Nitin Aggarwal from Motilal Oswal. Please go ahead.
Yeah, hi. Thanks for the opportunity. So, when you guide for a loan growth of 20% plus next year to make up for the slackness this year, how confident you are to grow the liabilities at a commensurate pace? Because the mix of retail deposits has been sticky around 40. So, would you not focus to grow this mix of retail deposits in a calibrated manner going ahead?
See, we continue to believe that we can press the accelerator on deposits at any point of time. The issue was in this, because of the excess liquidity which we had, we actually run off a little bit of our mature term deposits also. So, and I think it is only a matter of time that you will see this coming back. We did lose certain deposits because of our rates getting dropped. Not to say that we did not drop the rate. We dropped the rate on savings account. We dropped the rate on this. So I think it will come back. I've always said our liability growth will be higher than our asset growth, and we are going to continue to maintain that. We have given a 48 to 52% SBC plus LCR, and we will continue to stick to that plan.
Okay. And secondly, we have reported strong treasury gains during the quarter. So if you can provide some color on it, and how do you see this faring in the wake of tightening rate environment?
No. So there are two things in that. If you look at the other income, there are two things. One is the extent guidelines which have been modified, and 240 crores of income which came into the other income, and then there is a treasury income which come in. So the treasury income is around 250 crores, and then the other income is about 130 or 140 crores which have come in there.
Okay. And lastly, on the corporate yield, while we have talked about that the improvement in rating has driven this decline in yield, but it's still pretty sharp. And
what has happened? See, the MCLR, we've been dropping our MCLR, and the MCLR impact had to come in at some point, and it has come in. Number two, please understand that a lot of repricing happened because we were losing clients. The market rate on corporate banking is anywhere between 5.5% to 6%. So how do you manage your clients? So we had to give a little bit of a reflection on a yield, otherwise we would have lost a very good loan book, specifically in the SME side and in the BBG side.
And we have got higher rated clients.
And of course, there is a higher rated paper which has come in. Most of our disbursements is happening in higher rated paper, and we are moving towards working capital also in a large way.
Okay, sure. Thanks so much, Sumant, and wish you all the best.
Thank you. The next question is from the line of Anand Dama from Emkay Global Financial Service. Please go ahead. Anand Dama, may I request to unmute your line from your side and go with the question, please? If no response, we move on to the next participant. The next question is from the line of Alpesh Mehta from IIFL Securities. Please go ahead.
Yeah, hi. The first question is again going back to this ARC sale. So what I can see is the gross value is around, first and foremost, this is a 9-month number, right? This is not a third quarter number.
This is a third quarter number.
This is a third quarter number. Okay, so the gross value of the loans that we sold is around 2,500. The net value is around 1,200. So the provisions that you had made on this book is 1,275. That is the consideration. So how is this entire provision consideration received on the shortfall is being accounted in the reporting?
So I repeat the numbers again. So out of the 2,487 crores of sale to ARC, 1,737 crores is the sale related to retail MFI, all the books, and 750 crores is regarding the ILFS exposure. Now within this, 750 crore was fully provided, and the provisions include provisions till date, not just in the last quarter. So the net value of CNTL is 0. The net value after provisions of other loans is around 1,213. That is the number reflected in the disclosure. Against this 1,213 of net net exposure that we have sold. The consideration for that was 980 crores. Within that 980 crores, 240 crores is for the ILFS asset and 740 is for the rest of the book. Because the ILFS exposure was written off already, that 740 crores is a recovery and that does not get reflected in the GNPA movement. The 740 crores is the number that is seen in the NPA movement. And that 740 crore number then goes into the SR book for which we are carrying provisions.
Okay. So this 240 crores would be a part of the recovery from return of accounts?
Yes, it's a recovery from return of accounts.
And it's a part of other income?
Yeah.
Okay. And the shortfall between the 740 and 1230, 500 crores. So that is been adjusted against the security receipts that you would have done, right?
No, that flows through the P&L. Whatever is the loss on the sale to ARC flows from the P&L in the credit cost for the quarter.
Okay. Now the second question is on what is the outstanding quantum of security receipts on the balance sheet?
Yeah. So net security receipts, as covered in the opening remark, was 0.85% for the quarter against 0.71 last quarter.
Okay. And last question is on the margin front. While obviously throughout system we are seeing that the growth is picking up and some of the larger corporates are driving growth, especially in the third quarter, and which is likely to be the case at least for next 1 or 2 quarters. So what's your outlook on margins or your view on volume versus the margins? How are you looking at this situation?
Which margins are you talking about?
The overall net interest margin I'm talking about.
So our net interest margin guidance has always been between 4.15 to 4.25. We are not in line right now. We are lower by 5 basis points at 4.10. But I think as the microfinance business picks up, we should be there.
Okay, so even though you are planning, you may grow the large corporate book, but your margin should remain intact between that 4.15.
Because the mix of the book will also undergo a change at certain point of time, and that is where the mix, if it moves towards a little bit towards microfinance and credit card business picks up, you will create more margin.
Okay, and the last question, out of the total slippages, what are the slippages related to the MFI for this first 9 months?
So our total slippages in the quarter 3 was 2,598. 1,341 crores is from the MFI book.
And the first 2 quarters would be?
Quarter 2 was about 1070. Gross slippages. Net slippages was about 1,239 in the quarter 3.
Yeah. And quarter 1, if I remember, was around 150 crores.
Okay, so in case during the call, if you get this number handy, what is the gross number of MFI slippage and the net number of MFI slippage? That would be very useful. In case you have it handy. For the 9 months I'm talking about.
We'll try and call it before the call ends.
Okay. Thank you so much and all the best.
Thank you. The next question is from the line of Prakhar Agarwal from Edelweiss Financial Service. Please go ahead.
Yeah, hi sir. Just a follow-up on that as well. So this time around you said 980 crores is the write-off from MFI. What would be that cumulative number for 9 months? How much have we written off cumulatively from MFI?
We gave you that number, 1,800 something. Not write-off. Write-off would be very less.
Write-off last quarter was 430.
No, write-off 430.
Write-off 430. No.
1,632. 33 plus 9.
No, 433. We'll call it, we'll get you that number. 9-month number is not handy. I think we have disclosed every quarter what is our write-offs.
So we can give you quarter 2 and quarter 3, but we don't have the quarter 1 number.
Sure, sir. So if during the call, if you could provide that number.
Yeah.
The second is in terms of in terms of telecom exposure, has there been any change in that telecom exposure? Has something been repaid or something of that?
Yeah, 258 crores of guarantees were repaid. We're expecting another 300 crores to go off, and then we are expecting another 300 crores to go off in quarter 1 or so. So that's something which we expect. Then I think the ARPU guarantees, the decision has to be taken by the government, and we expect that decision to come through, which should be another 500 to 800 crores going off.
But nothing on fund-based side that probably gets reduced this quarter.
So we've already reduced 258, like I told, and we should only get another 250 to 300 crores reversed this quarter.
Perfect. And just last thing on this provision, the contingent buffer that you're carrying, what is the plan to utilize it? How we are thinking about it?
We will see. There was an opportunity to utilize. I was tempted to do it this quarter, but I think we think that we should keep it, and that's why we added to it also. And I think you should keep it and use it at an appropriate time. We will evaluate it next quarter because we want to come at a credit cost of 1. Today, if you look at it, my credit guidance was 190 basis of credit cost and 50 to 760 basis point on the Vodafone. We are already at 190 today and 40 basis point on the Vodafone. If I have to maintain the guidance of 190 to 200 basis point, I will see whether I have to use the contingent provision. I may not have to use it much, but may have to use 200-300 crores. So we will see whether we have to use it or we will bust our credit cost guidance. So we will evaluate it at certain point of time, at appropriate time.
And what would you be your credit cost guidance for FY23?
Not right now. We will come to it later because we've always said that our credit cost should now go down between 125 to 150 basis points. But I'm not giving a guidance. I want to see how COVID plays out.
Sure. That is it from my side. Thank you so much.
Thank you very much. Ladies and gentlemen, I now hand the conference over to Mr. Suman Khatpalia for closing comments.
So thank you for being on the call on a Saturday evening. I just want to tell you, thank you for being patient with us. You know, the whistle blowing was not an easy for people who had confidence in us and lost confidence. I think I want to tell you that the bank continues to remain strong, and we are very confident of the recovery phase, and we don't see any issue in what we said. Our microfinance business is strong, and I continue to believe that we will continue to grow the business and we'll continue to have a growth which we were anticipated. We would have achieved the growth target this quarter also, except for the microfinance. So we are well on our way to achieving our growth target. Thank you so much for me and Andrajit are available for any clarification, any doubt we have. We've not answered certain questions. We will make sure that that's uploaded in the investor deck. Thank you so much.
Thank you very much. On behalf of IndusInd Bank Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines. Thank you.